Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, April 2nd, 2020. So what I'm going to do in this video, we'll just start out very quick market wrap. Nothing technically changed today, so I'll start there and then we'll move on. I want to do something a little bit different to take a look at the long-term trend indicators, take a look at where we're at in this whole process of the market, longer term, near term outlook, and then talk a bit on trading strategies, risk management, diversification, where to make money, where to prosper, whether whether we're in a bull market, a bear market, regardless, how to make money at this point in time. Whereas a lot of people, friends and neighbors, I'm sure, are losing and have lost a lot of money. Maybe some of you have, and that's why you're here. But lately we're batting not 1,000, but close to 1,000 on official trades now for weeks. So it's been like I say, you can always hear hesitation in my voice. I've for years talked about I welcome bear markets because profits are very quick in short order. I love shorting, just like I love going long. This time there's a little bit of trepidation in that because again, this is dire consequences for the economy. People are dying, for what's causing this bear market, and so for that fact, I absolutely take no pleasure in it, but again, I'm going to trade what's in front of me. That's my job. That's what I do. So I'm going to talk a little bit about that. And again, the pitfalls are not just how to make money in this market by investing in certain things, by shorting certain things and profiting from stocks falling, but also how to avoid losses from blow-ups. And I'm going to talk on that in a little bit. Somebody brought up UWT today, DWT, those crude ETFs. Looks like they've blown up. I'm seeing cracks under the surface here in the financial markets. So there's other ways to lose money in the stock market besides buying a stock that drops and then selling at a loss. You can invest in the wrong thing, and that thing can, and I've seen it over the years many times, a stock just blow up, or a ETF, or some other type of investment. So I'm going to talk a little bit about that, so you can be aware of those risks. And again, if nothing else, money saved on the downside for a loss is to me the same as a profit. That's money that if you avoid losing, you sidestepped a position you were in. Maybe you were holding on something and you didn't lose that 20, 50, 100% on your money. It's just as good as having that money back. Okay, and if I can do the update on the markets in 3 minutes or less, that'd be great. And give me a little time. Won't be, I always say it, but this one shouldn't be a super long video. So I'm going to run through the stock market. Okay, here's SPY. This showed you today. And I talked on this morning. We had 244.93. This is the resistance, or this trading range we've been in. At the open today, that's this candle right here. They took it below it, but managed to close right back above it, held support, and all day bounced along this range. There was a little last minute ramp into the close. Means almost nothing, because when you have, the markets tends to either go up or down towards the close. That's where positions are squared away on ETFs and mutual funds. So you always see a surge of volume heading into the final minutes of trading. And I always say, disregard any breaks of support or breakouts above resistance. If they occur in the final minutes of trading, the chances are, not that it can't stick the next day, but chances are it was just last minute position squaring and not a legitimate breakout, so don't put too much into it. And again, it's pretty clear now. This is the trading range we're in, and my thoughts haven't changed from where I was at this morning. Whether we go up, try to backfill part of all that gap, I don't suspect it. I think we'll probably fail again if we enter the gap like we did back here, and I do expect a downside resolution of that. That's what I'm favoring right now. And then in QQQ, same story. Flip over to this board, official trade. This was a wonky print, this long stick here. You can look at the 1 minute chart on QQQ. See, sometimes you get these in the after hour session, right? Even actually we had one there. That's the one right there before the market closed. You can't even see it. The chart gets all skewed and flattens out when you have these, what I call wonky prints, and you had one before the close. So 186 pretty much is about and that's the top of that trading range. So again, ignore that. There was a print way up here. And it's funny how those erroneous prints always happen right on support and resistance levels. Maybe somebody had an order there and one single order was filled, but that's really not where SPY didn't trade through that level. It's in our QQQ, I'm sorry, it's in bouncing around in this level here between T1 and T2, and that's it. So still looking for that, whether we pop tomorrow or not, but I favor a reversal here. And NQ for you futures traders, NQ, same story, although the swings are a little bit bigger, but there's that 76.20 level that's been capping the advances in NQ here lately, whereas ES and then to the downside 73.74. So that's kind of the bigger picture. And again, at the risk of oversimplifying it, bullish to break above, bearish to break below, a break below bring it to any of the next targets down there, and that's still what I favor. ES, similar story here on ES, the S&P 500 futures. You have a trading range between that 2504-ish level down to about the 2460 level that I've highlighted. We had one little intra-period spike, but again, we closed back above it, so ignore those little skinny parts, the candlestick shadows there. That's our trading range there. And should we break to the downside, these are our next targets right there. Okay, now we're going to talk bigger picture strategy, and I'll explain this chart here in a second, but I just want to talk on what we're going to go through. Number one, I'm going to make the case that we're in a bear market, regardless of what the 20% up or down, what the what the media is saying. I'm going to make a case that we entered a bear market, and despite the bounce that we had recently, we're still in a bear market, and that at least as of now, until and unless anything changes in the charts, both primarily to me technically and also fundamentally, until I see a drastic change there, I'm going to treat it as such. And as such, what does that mean? Well, when you're in a bear market, it's like a bull market reverse. In a bull market, you buy the dips and sell the rips. In a bear market, you sell or short the rips. And let me put a little, it's not as simple as every little rip. Well, it's been working a lot lately for active traders, but you typically sell the rips or the bounce rallies into resistance levels, particularly those, and again, to take it a step further, to say it's not that simple that you don't sell a rip into every resistance. Everything we've been doing lately, you hone down to the intraday charts, 30, 60-minute, daily charts, and you decide which resistance levels are likely to be broken out above and open the door to the next one, and then which ones are likely to be the stopping point for the rally. So that's what we've been doing lately for the past few weeks here. And the other part is you sell the rips and then you cover or buy the dips, and then of course in parentheses you buy the dips down to support the support levels that you think will cause a bounce. And so I'm going to make a case here that we're in a bear market, and what it makes me think of here is if you're a parent or a grandparent or had kids in the last, even nephews in the last 10 years or so, you've probably seen the movie Toy Story. Let me pull it up. I think of and there's a scene in there where Buzz Lightyear, he's a toy, new toy. All the other toys are animated when the kid's not around who owns them. They come to life in the room, and this is their new toy the kid gets on his birthday or Christmas or whatever, and he thinks he's real. He doesn't think it's a toy. The rest of them know they're toys. So this analogy is, when I want to say that, look, we're in a bear market, I feel like Woody, who was Tom Hanks' character, You are a toy! That's kind of the mental image I get right now with the bear market is, it is a bear market and treat it as such. Don't be fooled into any rally, as impressive as they are. And again, until unless proven otherwise, because at some point, whether that point comes weeks from now or months from now, it will be proven otherwise that we're in a bull market, and then we'll treat it as such. Okay, so what I'm going to show you here, I'm trying to zero in on these charts. Let me change one little tool here down below, the color of this one blue, and I'm going to show you these what I call my quad indicators. I've shared these before. So what we're looking at from top left up here, this is a monthly chart, and I'm just going to run through the different indexes. I'm going to explain what we're looking at, then I'll go through them quick. I'm not going to go through each and every one. I have shared this in the past, but this is my one of my longest term trend indicators. Monthly chart goes back for, you can roll back as long as you want really. Then we move down here. So these are my weekly trend indicators right here, a couple on there. I'll explain those in a second when we get to that. And then my two daily indicators, intermediate or a little bit longer term, and then a shorter term, some shorter term daily trend indicators. And what we're looking at here, we'll start here. They're all on sell signals. Every single one on every single what I call true diversified indexes, except one. We're going to get to that in a second. That's QQQ. You probably realize where I was going with that. But let's expand this so you can see what we're looking at. So on this monthly, and I do have other ones. I've showed you many other trend indicators. I've showed you my 20-month period EMA. That's not on this chart, but it does a great job of defining bull and bear markets. SPY is below that already on a sell signal. Every index is. Every diversified index, it's representative of the U.S. economy. So again, everything but QQQ, which is, like I say, mostly, it's really, QQQ is not exactly, but it's pretty much a tech fund is what it is. I always call it XLK with an Amazon kicker, kind of jokingly there, but that's essentially what it is due to its extraordinary weighting. You know, half the securities are technology companies, and then it lacks other key sectors in the economy. So when we're looking at what is a stock market, what's the U.S. economy, well, the S&P 500 is one of the best indexes to use. It's well diversified, spread among 500 companies and over across 11 sectors within the economy, and even subsectors within those. And on this one, I have a 10-period exponential moving average and a 6-period, and they do a pretty darn good job. You can roll back in time of defining bull and bear markets. Now, you might not be able to see what I'm talking about here, and that's why I created these custom histograms down below. This is the custom histogram for the 10-6 EMA pair. What does that mean? Well, the blue line is a 10-period monthly average exponential moving average, and then the red is the 6-period exponential moving average, again on a monthly chart. And the black line is the S&P 500. And so what you can see here, there's the 2000 to 2002 bear market. There was the big crash, the 55% drop in 2007 to 2009. And everything in between. And so the way you use a moving average pair as a trend indicator is when the faster moving average, which is the 6-period, crosses down below the slower moving average. In other words, the red line crosses the blue line. That is a sell signal, and it's a monthly chart, so you don't get them often. And nothing's perfect, but this one does a pretty darn good job of sniffing out and telling you what the primary trend is. And so to make it easy, since you might not be able to make out those crossovers on the lines right there, you can see the histogram, which visually shows you when the 6 crosses the 10 EMA, the histogram will flip from green to red. And that's it. So what it told you here, and this is 401k long-term investor stuff. For many years I talked about this, and although I identified pullback opportunities, swing shorting ops in the market throughout the bull, I said this is when you get some solid sell signals here in these long-term indicators, that's when it tells you that's the time you don't want to be in stocks. There's really, again, do what you want, but that's a good time to be fully or mostly in cash, and whatever other options you have. Again, we talk about bonds, commodities, gold, other ways to make money besides stocks. But there it is. So if you just use this indicator alone and nothing else, and even if you took the signals religiously, which I do not, I always say I have scrubbing indicators. I look for other things, trendline breaks, other different indicators, but just using this alone, look what it would have done for you back in the last 2 bear markets that we're at. It would either got you out or put you in short to let you profit over those 50+% drops on both of those bear markets. It didn't get you out at the top, and it didn't get you out at the bottom, didn't get you out of the market or back in at the bottom, but it did a pretty damn good job of capturing the bulk. And especially, again, if you do not short, it did a great job of telling you to, hey, get out and stay out, and then you sidestep this and this. Now, there are whipsaws, I talked about it, but I also have confirming indicators in most cases here, not all, but most cases counter those out. And so even, again, if you took the whipsaw signals on this one alone, in other words, shorted when you had that monthly histogram cross, because it only matters at the end of the month, and then it told you, okay, cover your shorts, get back long again, you would have had a few whipsaws within this 11+ year bull market, with minimal, if any, damage. You would have caught 99% plus of the return. I shouldn't say that, because you would have missed the very move on the bottom. Yeah, that's a little less accurate, but you would have caught the bulk of it, about 99% of it. In as far as time goes, you would have missed a good move there on the bottom. But again, where am I going with this? Well, we had some whipsaws, and you can see what a whipsaw signal looks like when the lines they pinch, they come down, kiss, and sometimes slightly cross, and that's indicated by the small red. This isn't a whipsaw. This is an unmistakable sell signal, as is the ROC13. That's another rate of change. It's a completely different indicator that I use. I'll toggle between an ROC13 and an ROC12, and they both tell me the same thing. Make no mistake about it. This is, those histograms. In other words, the lines have made clear and definitive crosses, and that's from the end of March right there. And here we are so far on the April bar. Now this is going to yet to be seen. We have to see how we close next month, but that's pretty solidly bearish territory right now. And so now what I'll do is quickly go through all the rest. I'm going to collapse this, tell you that I have the same thing here except a weekly indicator. What does that mean? Well, on the weekly I have two different moving average pairs. I have let me grab this and jump here. I have a 17 and a 43. So the 17 is your faster moving average, the 43 is a slower. Again, it's on a weekly time frame. You can roll back as long as you want and see that those pairs, same story. There's the histogram down there, have done a pretty good job. And because you're on a weekly chart, you're going to get the signals faster. So this will help you get out at the top earlier and also back in at the bottom earlier. Now the trade-off is you get faster the signals you go when you go down to a daily time frame, or you're trading on a 60-minute time frame with trend indicators. Your signals become faster, telling you earlier on that the trend has changed, it's now bearish, get short or get out of your longs, and vice versa. But the flip side is you have a higher rate of whipsaw signals. So that's why I wanted to start out with that monthly, show you how solidly those sell signals are right now, how deep those lines have crossed, how far apart they are, and the fact that anything is possible, but they're probably not going to prove to be whipsaws. So I'm spending a lot of time here making the case, just like Woody was to Buzz Lightyear, that you are in a bear market, and hey, maybe be wrong, maybe this thing just goes away tomorrow, but I think most of you probably agree, best case scenario, coronavirus is not going away tomorrow. All right, so there's the again, you can see the cross right here. Boom, get out of your longs and or get short, and then boom, and it came closer there. Here's the crossover right there, and it's telling you bull market, bull trend, be long. Bear market, bear trend, whipsaw signal, trade as you like. And here you can see now this bar, look where we're at. I'm trying to zoom in a little bit. Let me move this up so you can see this bar, the depth of that, how far apart these lines are right now. They're clearly indicating a sell signal. Those other whipsaw signals never went down that low. Doesn't mean that this one can't be a whipsaw signal. It just decreases the probability that it's a whipsaw signal. All right, so that's that. And then same thing, I'm not going to do them all here. 50 and 20-day moving average on the daily chart. You can just glance here at the video. I know the screens are smaller when I'm showing all four, but clearly on a sell signal now, as are even my shortest term trend indicators on this of course view, which are a 20 and a 13. Oh no, the pair is the 13 and 26 EMA. You don't see the pair up top, but it's right here on this bottom one in a histogram. And then a very simple view, I do like this one, I'll show it to you expanded, is just put up a 20 period exponential moving average on the S&P 500. And there's two ways I use that as a trend indicator. It works pretty well. Number one, if the S&P 500, which is a black line, is trading above it, the trend is bullish. And you can see it was bullish, bullish, bullish. We came, and that EMA often acts as support or resistance when tested from above or below. Had a couple whipsaws there, but other than that, it told you the whole time, hey, be long and strong up until that point, other than these two whipsaws. Here it crossed, and it wasn't a little whippy signal. It said get out. The trend has changed, and that 20 EMA we're still below. We've run up at it, didn't make a full back test, but we're still below it. And again, the point that I'm making here is by nearly every metric I use, the trend is still bearish, and as such, rallies should be treated as shorting opportunities or opportunities to exit your longs. Best if you can do that strategically, meaning align it with technical analysis. Like I said, for the last few weeks, I was looking for a bounce. I gave you those targets, so we didn't just short the or get out of longs on the first 5% bounce. We use technical analysis to be our guide as to when that trend would likely be over, which I think it is now. I think it already ended, and we're still off the those recent highs. So, all right, let's move on to the next topic here. Okay, so I've spent a lot of time in recent weeks and months, and it's what I do pretty much 24/7 on this site, around 365 days a year, or at least when I'm posting, is how to make money, where to profit. I don't care. Give me a bull trend, give me a bearish trend in the market, doesn't matter. I'm always there. You'll see at almost all points in time. We'll have both, whether they're official or unofficial. I'll have a mix of long and short trades, and I'll welcome you to find another trade or another service that is so broad on what I'll trade. 1 minute I'm talking about soybeans, the next minute I'm going long Bitcoin, then I'm shorting corporate bonds, or going long treasuries, and trading futures. Like I say, if it has a ticker and I can buy or sell it with a few clicks of the mouse, I will trade it. So I like to look for opportunities, especially in obscure places, things that nobody else are looking at the time. I like to be alone on my trades when possible. Those are the best trades that you get in before anybody else really realizes what's going on, and the charts will usually indicate that. I'm open to fundamental stories. I know a lot of you did share some ideas recently, and I'm going to try to get to those. I did see a lot of suggestions on the homepage. I've been very busy, but I will maybe I'll even go through a video and try to address as many of those trade ideas as you guys gave me. I was asking for ideas that companies that might benefit from what's going on with coronavirus. But now we're going to talk about risk avoidance. So again, it's not all about making money in the stock market, especially in a bear market. It's probably as, if not more important, it's loss avoidance. So earlier today in the trading room, I stopped in to post an update on gold, a trade setup there. And I saw that member Weatherman had mentioned LK was whacked. It was down. You can see right here, it closed down 75% on the day. He had said, or someone else had said in there, corporate fraud. Now, I didn't look into this, but this is a good example. And what I replied to that is, I remember, back in 2007, Warren Buffett said in a letter to his shareholders at Berkshire Hathaway, when the tide, something to the effect, when the tide goes out, you'll see who was swimming naked. And what that meant is it takes a bear market, a sudden crash or big drop in the market like this, cracks in the financial system, to expose companies that were operating for a long time, either with improper risk models, meaning too much leverage, other factors, or outright fraud. And from according to this company was cooking the books or something like that, overstating earnings. And again, I didn't look into it. I'm just passing along what I saw there. But I can see enough that the stock dropped 75% in one day. Something's amiss. And so, again, think Bernie Madoff. That happened, came out in the last financial crisis. So those things are going to come out. And where I'm going with this is more of that's going to come out. We're just seeing the beginning. The stock market has dropped 35%. It fell from the highs to lows about 35% in less than 2 months. And worst part is, I don't think it's over. I think there's more downside to come. So where am I going? Okay, Randy, how do I avoid this? Well, first of all, you want to be very careful. Do your due diligence on buying and holding companies that are obscure little companies. I've never heard of this one, Luckin Coffee. I've never traded it. Maybe it's a big company, but you're probably not going to see a 75% drop in Amazon or Apple to find out they were cooking the books. Why? Those are some of the most widely held companies, so scrutinized at such a high level. Rarely are you going to see a company like that. So you stick with blue chips. You can certainly suffer losses. Those companies fell and probably will fall at the next bear market 50% or more. They dropped over 50% in the last bear market, and they'll probably could very well do that again. So you can have losses from a decline in revenue and fundamental outlook on those companies. But that doesn't happen overnight like this. So the takeaway is, I've used this analogy before. I used to be a financial advisor, and we had a thing called the Know Your Client rule. It was required back then. It was FINRA. I'm not sure the regulatory agency now, meaning if a customer came in to invest money, I couldn't just turn around and say, oh, buy Apple. It's the best stock out there. I love it. No, I had to ask them, what is your risk tolerance? How much money do you have? Where is your money right now? Maybe they have 3/4 of their money in Apple, and therefore that would be a bad investment decision. So just like investment advisor needs to know their client, just like your doctor, when you go to a doctor's office, he or she doesn't greet you with a prescription. You fill out this whole long medical questionnaire. So what I'm getting at, if you want to trade individual stocks, I call it the know your securities rule. You better know that company, know what their business model is like, know what their fundamental situation like, and at the end of the day, you can do all your due diligence in the world. There are going to be the WorldComs of the world. There's going to be the LKs of the world, because again, you might have done your due diligence. They had a strong balance sheet and all that, strong earnings. Guess what? They were lying, and this is what happens. So, okay, how do you avoid that? Easy. You don't put all your eggs in one basket. If you're going to trade individual companies, it should be a small portion of your portfolio. You're better off especially if you don't have the time for the due diligence or the skill set to dig apart a company's balance sheet and look at their fundamentals. Stick with ETFs. And then that segues into my next thing. So when you buy SPY, you're buying one security, one click of the mouse or whatever, enter your order and then hit submit, you know what I mean. But effectively you're buying at that point in time, you're spreading your money. You're buying one security, but you own 500 different companies. Not only that, you own the 500 largest companies in the US, blue chip companies, mega cap stocks, very well vetted, and chances are you're not going to see an LK situation in any of the S&P 500 components. Chances are. And guess what? If you did, and one of those 500 companies went to zero, it's not going to have a huge impact on your investment here. So that's tip number one. Now take it a step further, and let's talk about the other risks that I've mentioned recently about ETFs and ETNs. An ETN by nature, all other things being equal, is more risky than an ETF, because an ETN is an exchange traded note. It's a promise. The only promise, or the backing of it, I should say, although they are tracking an index, it's issued by a company, and it's that company, an IOU to you, they're backing. If they have I've read through these prospectuses, I've seen these things blow up. They write it in there that if they, pardon my French, I'm going to put this on public, we'll just say F up. If they F up in managing whatever they're tracking, guess who it's on? It's on you, not them. They pass along those losses. Like on this one, somebody said today, again, I didn't look at it to verify this, but it looks that way to me. Crude oil was closed up 17%. At one point today, crude oil was up, this is USO, I'm just picking, it was up 30%. Okay, so let's say you were bullish on crude, so you bought UWT yesterday. Guess what? Not only did you not make the 90% you should have, because this is 3-time leverage long, you would have been on cloud 9 with a 90% one-day return, right? Oh, sorry, you lost 6%, and they're going to give your money back. They're going to shut this down. So now you have no possible option of making that 90% gain that you should have had today. This is a lesson. This is what I talked about. This is 3-time leverage. They used, some financial, pretty slick financial engineering to juice up the return of crude oil by 300%. Because it's an ETN, they're not holding, there's no physical there, and even in some ETFs are not. But again, that's an example, and its counterpart DWT, and we've traded these many times over the years. I've had trade ideas on both of these, but guess what? Right now we're in a different environment. Right now, remember for the last several weeks back before it started happening, I said you're going to see things start to break if the market continues down. This is what I meant by things breaking. And we've seen it with mortgage REITs. I can't remember the ones offhand. There's several mortgage REITs that have blown up to the tune of over 70 or 80%. And these are things that are usually considered, let's see if I can find one here. These are things that are usually considered very safe. I'd have to find a particular one. I'll just click on that one. And what happens is a lot of these mortgage REITs, they use a pretty high degree of leverage to juice up their returns. People buy these, and unfortunately, and this is where I think, this is me, I might get a little a little dramatic here, but I think the Fed has been almost criminally negligent, and I've been maintained that view for years, by taking rates so long. I get what their intent was back during the financial crisis, but to keep rates at the floor for over a decade, and then yeah, sure, they tried to lift it up a little bit. What it did is it forced mom and pop investors, because this is what I used to do for a living, people that are retirees in or at or near retirement, including pension funds, they were forced to take higher risk to chase yield. So they were buying things like junk bonds. Why? Because they could no longer get 6% in a CD or 5% on a treasury bond, or even 7% on investment grade high quality corporate bonds. And so and I know this to be true. I've read it, and again, it's what the Fed has done. They forced investors' hands, and again, not just those that are young that have time to recover from a huge drop, but those retirees that could not live off a 0.5% CD. You just couldn't do it when you're coming off a fixed income portfolio and you don't have any more earnings in retirement, and you're rolling your CDs down off 5-6% over the last decade. The ones that were that's where they were at before we headed into the financial crisis, and you had those coming due at 2 and then 1 and then at some points under 1%. You had no choice, or they had no choice, but to run into those type of things. And so again, this is where, like I said, it's just a very long term, and you guys probably don't know where I'm going with this, but I'm talking longer term. Near term right now, there could be more blowups, is what I'm saying on that, because a lot of people have been forced into these. Now, this is J&K. That might not necessarily use leverage. I'm just kind of pointing out that people that normally should have never had their money in junk bonds, at least a good portion of it did, because the yield was so high. And, junk bond ETF fell 25%, and sure, it bounced, but you look at a long-term chart and knowing where we're at in the economic cycle, we're in the very infancy of the next recession, the first one in over 11 years. And if you think it's going to be over anytime soon, I hope it is. I hope I'm wrong, but history tells us it's probably not going to be, even though coronavirus was the catalyst that started it. Even if coronavirus went away tomorrow, I think the wheels are in motion. Damage has been done, and we're gonna see more to come, and there'll be rallies along the way. But an investor in junk bonds, or J&K for example, probably never get back to where the value were, at least any time in the foreseeable future. And many of those other investments, like I said, those mortgage REITs, things like that blew up, leverage trades, that kind of thing doesn't come back. Those ETFs and REITs may be around, but they cannot and will not recover an 80% loss. There's just no way to do it. Those bonds can't possibly go up that much. Remember, if you lose 50% on an investment, you have to then make 100% return from there to get back to where you started. So the math is almost against them, especially with what they're holding. The type of investments, they can't turn around and buy the next big, tech stock that might go up 1,000%. They can't hold things like that, so they have really no chance to recover. Okay, so kind of move off that topic, just to reiterate, ETFs overall I think are still a good investment vehicle, let me say that. And some ETNs, especially those that don't use leverage, there's an example I used before. USO tracks crude, and that's about what crude futures did. It's non-leveraged. Is there more risk than crude futures? Yes. Given the choice, I think the futures are the safer bet, but I know a lot of traders don't have the skill set, the experience, whatever, to trade futures like CL. And USO is a viable option if you want to trade crude. And again, there's no way to completely eliminate the risk of this one blowing up or anything like that, but you can certainly mitigate the risk to you by not putting too much into it. And then again, in this market environment, whereas we might have normally been in DWT or UWT a while back, not at this point in time, not until the risks abate. And by the time that's done, there'll probably be other ETFs and ETNs blowing up. And then as far as what else to do, if you want to short, because let's say you can't short because you don't have a margin account, or you're trading in an IRA, well, you can short SPY by using SH without any leverage. So that's going to be one option there. They do use derivatives. It's their way of shorting the market, but they're not juicing up their returns and their risk with leverage. Now you can multiply times 2, go to SDS. A little more risk, but a little more returns, as I talked about, gives you a little room in your portfolio, because instead of buying $10,000 of SH to short, put a $10,000 short or a hedge on your long positions, you can go with $5,000 of SDS, and you're effectively hedging $10,000 of long positions or shorting $10,000 in the market. So this one was probably fine. I won't give any guarantees. And you can kick it up to SPXS, is the 3-time leverage one, and they're doing fine now. And they're also, the other thing that I mentioned to somebody in a comment section today is, yes, this one is certainly going to be more risky than SH or even SDS because of the 3-time. However, it is tracking an index that isn't going to go up and down as much. The reason those crude ETNs blew up is because crude, as I just showed you, went up 30% today. And it's been dropping down a lot. And so where I'm going with this is, with the whole know your security thing, if you're trading, I'll tell you who's at risk are the ones like natural gas, UGAS, DGAS. Over the years you've seen me trade these guys left and right. You're not seeing any UGAS and DGAS trades right now. They're 3-time leveraged, they're ETNs, and they track one of the most volatile commodities out there. So it's the volatility of the commodity just as well that puts you at risk. So I've seen natural gas move up. I've seen natural gas go up to 20% in a day. You're not going to see the S&P 500 normally, and natural gas can do double-digit returns in a day in a normal stock market environment. So you're going to have more risk there. Nugget and Dust, they great vehicles at the right time. These are the gold mining ETFs, but remember, gold mining stocks are volatile. So while I'm not going to tell you whether to outright avoid these or trade them. Right now, they seem to be trading well, but you might want to step your leverage down if you can and just trade GDX, which is the non-leveraged, one-time tracking the gold mining stocks, and you can go long or short that. All right, so that's just kind of a heads up, things to be aware of. And again, there's risk with anything you buy. You cannot, if you want to put all your money, even a treasury bond in some form or another, even though it's considered one of the safest investments in the world, I think it has risk because there's interest rate risk, there's other things there, and I think right now the U.S. government is just writing a bunch of checks. They're going to have a hard time cashing or paying off down the road. So bonds are not a good thing there. Probably going off on a tangent, but I just wanted to let you know there's not many outright safe investments. You can put your money in a money market fund or nothing, a CD, a checking account. Those are safer options, of course, for you. All right, and then finally, let's wrap the video up with, let me make sure I got everything I wanted to so far. That's it. Yep, diversify among different asset classes. Those are stocks, bonds, cash, commodities, precious metals. That's one way to mitigate your risk. Proper diversification as well as diversification among position sizes. I hit on that. Be careful and know what type of ETN or ETF you're trading and know what it tracks. That's another thing there. And then finally, one thing I would say going forward is be aware of the obvious trades. What I'm trying to do is always, you're seeing things that, for example, what did we add today? One of the commodities, it was sugar. It took me a second because I was about to add, and I may still add cocoa. I mentioned cocoa as one of my favorites the other day as well in the end of that video. And so we had that, the pop today, talked about that. You can see in the comments section, I posted an update. Whether the post I made caused this or not, that the big move that we had in SSG sugar today, right after I posted the setup, or shortly after it did coincide with a breakout of the bullish falling wedge. Remember, this chart was included in that post, and we went on to pop, and so that pop would have also. The big question is it tail wagging the dog? Was it the buying into SSG? Because then SSG is a fund company, an ETN. They have to turn around and buy futures. Did the buying in SSG cause the pop in the futures, or did the pop in the futures cause the pop in SSG? We'll never know for sure. I can tell you this: I've run this site for a long time, and I've never seen a trade idea that I put out there that looked like it moved the market when I sent the post out. The only time I've seen stocks explode, and there's been hundreds that did this, but only when I posted a setup in advance. And technically that's what this was. What I mean by that, well, if I said, a lot of trade ideas are posted pending an entry. Let's say, for example, that I posted this setup here, and I didn't show you this line. I just said, okay, sugar or SB in this case. I know it's futures, but just say this was an ETF. And it was right here at the time, and I said it will trigger a long entry on a break of the downtrend line, which is a bullish falling wedge pattern. I just drew it there, and that 1073 resistance level. And then that pops, and that goes up big. Well, I've seen that happen 100 times, hundreds of times, and that's because that's not anything I'm seeing. There's obviously other traders that are trading, that are watching sugar and can see this very obvious downtrend line, at least obvious to me, and bullish falling wedge pattern, and that price resistance level. So if that pops, it's only logical to think you're going to get a surge of buying as maybe shorts cover and the long step in to buy it and swing it up here. So again, I just wanted to kind of address that going forward. If I like I said, I wanted to get that post out to you guys. If there are some special instances or unique circumstances with a stock or an ETF, like with SGG, it is thinly traded. And as again, I followed up on the second post. Trading is complex. There's a lot of things out there, and in hindsight, I should have taken the time to put in there, hey, guys, this is a thinly traded ETF. Don't buy it with market orders, because if you put a market order in, they can fill you at whatever. And if a lot of market orders go in, if you put a market order in when it's moving fast, the price can fill. You can be filled at a much higher price than you were, expecting to be filled at. So in that case, as I said in that follow-up post, use a limit order to buy. I like to split the difference between the bid and the ask. If they don't fill it, I'll move it a little higher towards the ask price. Or I like to use also the IB algo programs. They do that for you. Their algos will sniff around and move the price around for you and try to fill it in the same way I just said, but in a much faster manner. And they're also looking at the level 2, everything else that they have, and they do a pretty good job. Not always. Sometimes those sit there stale and they don't fill, and I have to cancel it, and then or change. On Interactive Brokers, they have a selector where you can say on the IB algo order, where it's trying to find the best price for you to fill it at, the default is normal, but you can say urgent, and then it will more aggressively try to get you filled at the best price. And sometimes it's not as good as just letting it sit there normal. I just want to throw that out there, because those are the little nuances involved in trading. Okay, so we'll wrap up here with as far as trading the bear market, what I would say is avoid the obvious. What am I talking about? Okay, Carnival cruise lines could go to zero, but a lot of the meat's been stripped off the bone on that one, so that to me is an obvious trade. As is American Airlines or any of the other airlines, they all look the same. Planes still, when I say planes aren't flying, I'm speaking metaphorically, not literally. But flights are way down. So those again are the easy ones. Everybody knew and heard that's that's probably the biggest impact is on the travel and leisure sector, is Travelzoo. And hey, there may be more downside to these. So I'm not saying these aren't good shorts, but what I'm trying to sniff out unique situations. And one that I'm going to give you here in a second is there was another flag there in Travelzoo. I hadn't even really looked at this. These are old lines. I had this line back here. Let's see, I created that back in January of 2019. And the last time I pulled this chart, last time I modified this chart was updated back in February of 2019. And then we went on to break that recently. I sure wish I had a price alert set there. I could have jumped in on that little bear flag and rode that down. But all right, I digress. One that I'm looking at, and I'm trying to find out opportunities. I'm going to pick on one that most of you might say I'm crazy, and that's Costco. I'm thinking about adding this as a short trade idea soon, a short setup. What is a setup? Remember, a setup is not an active trade. A setup is a chart pattern in a bullish or bearish posture. In this case, this is a bearish setup. You have 282, very, very well-defined support. Yeah, it was a breakout right here, and we have clearly bearish technicals. Negative divergence has been building for quite some time now. We had a divergent high right here when this bearish rising wedge broke down, but what happened is we kicked back, made a marginal new high, a lot like the stock market did, and many other stocks. And then we had a big red candle. Remember, everything gets dragged out. So why am I picking on Costco? First of all, let me tell you, I love Costco. I've been a member forever. I have one of those executive memberships, higher one. They give you cash back. Because in a good year, I spent over $5,000 a year at Costco. Buy a lot of stuff from Costco. I can't speak enough towards it. However, I think right now, it's held up relatively well compared to the stock market and everything else, just like Amazon has. There are some companies that are holding up as they should. Costco is only down, well, let's just say at the lows it only fell, when I say only, but that's, being that it's heavily indexed, this is one of the top components right up there, like within the top 10 or so in QQQ. It's about a 16% or so drop, and right now from the highs, again, I'm talking it's all-time highs, it's only 10% off those all-time highs. Okay, so in daily chart, negative divergence, you can see a little trend line right here, and you can see support right there again around 280. You can give it the benefit of the doubt, say that lower level. Costco to me is poised for a drop from where we're at right now. I think this stock within the next month or two will drop 15% at least, and that'll be the first target, and I think it'll bounce there around 246. Now, why Costco, Randy? Everyone loves Costco. They're so busy, they're having to limit their people to 30 people coming in the store. They can't keep their items stocked. Well, I'll speak to that. Okay, so people probably think Costco, like Amazon, is benefiting from this. I don't think so. I think their earnings are going to get beat up bad. Why? What are they selling? What are people waiting in line for hours in some of the Costco's to get into because they're limiting now? They even cut back today. I read they cut back to only one other person can come in with you. They're selling toilet paper when they have it, water, hand sanitizer. They're selling low profit margin items, number one. They're not selling, right now, I'm speaking again, just generally speaking, they're not selling the 82-inch TVs and the big, $3,000 furniture sets and their Hawaiian vacation package and Fiji and all that stuff. They're not selling that. That's where they make a lot of money. They're selling things they don't make much money on. On top of that, number two, they don't have a lot of those things. They're out of stock. People are coming in and they're either out of stock, and if they do get some in, they're limiting the number of sales to each person to try to, so they don't have a lot of hoarding. I don't see this, what's going on right now, as a benefit. I see it as a big negative to Costco fundamentally. And then finally, I mean, that's about it. Just the fact that, like I said, they, people right now love their Costco's more than ever because they have, like bulk items, those kind of things you want. But it's also, people are going to go in. There's been a surge. The shelves get cleaned out on those, those staples that people need, especially the toilet paper and the hand sand, stuff like that. And sure, people are, loading up on food as much as they can store. But as I talked about recently, that creates just an initial surge, but then it depletes back-end demand. If you buy 20 bags of, their 10-pound bags of pistachios and chips and all this to kind of fill up your basement or your cupboard for this whole storm we're supposed to weather through, you're not going to buy another bag of pistachios for 2 years. So again, it's creating a short-term demand on some items, particularly low margin items, food, and probably destroying demand on a lot of their higher end, higher margin items. Not to mention the fact reduced store hours, extra costs to pay the employees to come in and sanitize the store every day and do all that other stuff, supply chain disruptions, et cetera, et cetera, et cetera. So I'm looking at a stock that is about 10% off its all-time highs with negative divergences, while we've just entered clearly entered a bear market. And before all is said and done, I gave you my first target there, about a 15% drop. Here's a trend line we'll probably come and visit, so there might be a lot more than that. So again, it's all about timing. So right now I don't have a short on Costco, nor is it an official trade on the site, but I wanted to share that and just share one example, and how I think and what I'm looking for here, because there's going to be opportunities. This fast-moving market like this is where stock pickers can certainly outperform the indexes by sniffing out the most bullish and bearish stocks, focusing on those. And as far as shorting goes, we talked about the companies blowing up. Well, that's the kind of market you want to be short in. You can short those 3-time leverage ETFs if, instead of, let's just say hypothetically, I'm not telling you to do this, but if let's say you were you anticipated this bounce in crude. I mentioned the other day, I showed you a trend line that if crude took it out, that would likely be the start, the catalyst for an explosive short covering rally that one was coming up. So let's say you thought that was the case. Instead of going long UWT, which we already talked about how that would have worked out, you could have shorted DWT. And by shorting DWT, well, it froze. But some of these actually implode. So maybe that example wasn't great. If you shorted it, it went nowhere too because they're delisting these. I think they said they're going to, these are just going to be liquidated. But there are others like some of those, those VIX ETFs, ETNs that blew up back in 2018 when we had that big surge in volatility. Those went down. Those where they should have went up, they dropped 80, eventually 100%. They went away and they delisted those. So what I'm trying to say is in a market like this, there's actually, in some cases, more risk to being long than to being short. But you got to know what you're doing and what you're shorting. All right, we're going to wrap it up here, guys. Long video, but again, these are kind of random thoughts bouncing around my head, and instead of just looking at the same charts every day, I just wanted to kind of give you some, some what I think is useful advice on how to, navigate the, this or the next bear market that we're in. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.